Good evening, beautiful people. It's Elena Bartosh, your real estate investor. And today my podcast is, as always, as usual, about private money lending in real estate. And today my guest, very interesting person, cool guy, real estate investor with so many different ideas, with so many innovative type of businesses, James Brown. Hi, James.
Hey, I'm glad to be here.
Thank you so much for being here. Thank you so much for accepting my invitation. How are you, James? How is your day today?
Busy. I feel like the guy with the plate spinning, trying to keep him going most days.
This is a life. This is reality. It looks like. Yeah.
Yep.
Cool. Yeah. Awesome. Awesome. I love being busy, and I know you like it too.
Yep.
Cool. James, could you please tell people who watch us right now and who will be watching us later, who is James Brown?
Well, full-time real estate investor, licensed realtor as well. I got licensed to help with investing because I got into real estate on the investing side, not to become a realtor. So kind of did it in that order. So yeah, and we can dive into where we're at now. Definitely been a journey, trying different things and having shiny object syndrome, trying to figure out what was a good path for us. Because there's, as you know, there's a lot of different real estate strategies and asset classes. So we had to pick, me and my business partner, Toby, had to pick what felt right for us, where we thought the best opportunity was, and try to figure out what, there's a lot of different ways to go. Fix and flipping, that's like a job. I wouldn't call that investing. It's highly risky. You have to know what you're doing. There can be some big paydays, but you could lose a lot, and there's just a lot of moving parts. That's not for me. I mean, I'd like to make homes pretty, but anyway, we've gone different directions, which we can cover today.
Awesome. Okay, you're not on fix and flip. So anyway, what is your main focus right now in real estate? What are your goals? Where do you want to be in a couple of years, in 2 years, in 3 years? So what are you building right now?
We have added in, we haven't necessarily pivoted, but we've added in co-living. So renting by the room, single family homes, multiple rooms, and I can get into the reasons why we're pivoting into that or adding that. But so that's what we're doing, working with investors, building a portfolio, cash flowing properties. So I don't have a number set for like where I want to be in next year or the next year necessarily, but the way things are going, we should have, let's say, 10 properties under management in the next year by our partnerships and different ways we're putting those deals together.
Sounds ambitious. Yeah, I know you are co-founder of Hybrid Real Estate Investing, and you are into accelerated capital.
Yeah,
Could you please
capital.
explain us a little bit more what is the difference and what is hybrid real estate investing about and what is accelerated capital about? Just a little bit more information.
Okay. Hybrid real estate investing is basically a brand that we've given to what we also call reverse lease options. So lease options meaning rent to own. How those work is we find buyers that can't qualify for a loan with a bank. And there's a lot of people that don't qualify for loans that want to buy homes, right? So we're filling this need with people that fit that program. Usually self-employed people that they have some money, but the banks don't like us self-employed people. We're self-employed. We know they don't like us. So once we realize they fit our program, we'll let them pick out a house on the market,
Mhm.
and then we'll buy it for them as long as they fit our program. And so we just rent it to them until they can get a bank loan, 1 to 3 years typically. So that's hybrid. It's kind of a hybrid of regular, rentals and the benefits of flipping, like higher money up front, cash flow, back end payday, without all the cons of like a long-term rental, like maintenance and repairs and vacancy that can really kill you. There's much less risk of any of that with rent to own. So we can dive into that. So to answer your question, that's what hybrid real estate investing is. Accelerated Capital, that's a brand we came up with that is basically our private investor club. And a private investor club is, a group of people that want to invest together. And the reason that we created the club is we've also raised money for large syndications, like 200 unit townhome complexes, apartment building. So we just did the capital raising on those. With syndications like that, there's some rules. When you're raising money, you have to designate whether it's a 506C or 506B offering. So 506C means you can advertise that to anybody, but the investors have to be accredited. So they have to earn $200,000 a year as an individual, $300,000 as a couple, or have $1 million in real estate assets, not including their primary home, and or be a professional, real estate professional, full-time. So that's basically what accredited is for anybody that doesn't know. So that's 506C. You can also raise money from people that are not accredited. That's 506B. And there's a limit to how many people you can raise with. But you have to have a prior relationship with them. And so that's where the club comes in. Like, we get to know people through different ways, like we have webinars and training and meetups and, get to know people. So that's what Accelerated Capital is our investor club.
Actually, it was my next question. How do you involve and how do you meet and how do you involve private lenders into your club? And you just started answering. Webinars, meetups.
Yeah, meetups. So we're based here in Colorado. So, we've got the Colorado Cash Flow Club is what it's called. So we do that once a month. I go to a lot of other events. I host 2 other shows this month in real estate investing. That's a monthly show. And then I co-host the Mr. Rent to Own Homes show with Dominic Danino. Those are other ways that, investors find us, and friends, family, just referrals. Those are kind of the main ways that we connect with other investors.
Yeah. And could you please tell a little bit more about webinars and meetups you attend? I suppose not all of these events are real estate events, right?
Most of them are, but
most of them
are. So it's a little bit of a vacuum because, most of them are active investors that are doing their own thing, but sometimes people come in that just want to be passive investors. But that is a really good point because, like doctors, dentists, those are, high paid, busy professionals. That's a perfect example of somebody they don't have the time to figure out real estate. I mean, it's more than a full-time job for us to figure it out, right? They've got their careers, they make their money, they just want to put their money to work. So that's like an ideal person, but they're not coming to these real estate investing meetups. They might show up once or twice, right? So being in rooms, maybe it's a golf club or sailing club or wherever else busy professionals might go. charity events, those kinds of things.
Yep.
That's, and I need to be more active in that.
I agree with you that capital raising, I mean, real high level capital raising, when you make deal with people like doctors, like lawyers, this is full-time job. Yep.
Another one is LinkedIn.
Okay.
There's a lot of, business owners, let's say. They might not be doctors and dentists. Doctors and dentists aren't going to be on LinkedIn. But there's plenty of business owners that, again, busy professionals, want to put their money to work in real estate, just don't know how to do it. Otherwise, they're putting it in the stocks, not getting the benefit of real estate, right? So, yeah, that's another good place to find investors.
Yep, it's another source, right?
Yep.
Great. So you just connect with people, start with them regular conversation, several sentences about what you are doing, what you're offering to them, right? And then their turn, their part to reply to you or not.
Yep. And it's just a conversation, right? Just have to know the right questions to ask. So that's really part of the process, is asking the questions, just getting to know somebody, like what's their situation, because everybody's different, and it changes too, right? Like right now, somebody may have a business and 2 kids, and that's their thing, but maybe the kids are out of the house and they want to move and sell the business. Totally changes like where they're at in their investing journey, like what's a fit. They may want to just get totally hands off, no active investing, and get into a DST, like a Delaware statutory trust, or some kind of a REIT where they're not getting the max benefit, but they're just parking their money, and it's that's they feel safe and secure in that. So.
And do you have experience? You just mentioned LinkedIn, right? Do you have experience when you were able to get this person as a lender from the LinkedIn? And could you please share with us a little bit your strategy? You mentioned right questions. What are right questions? What do you want to get from them? What kind of information important for you to understand?
Yeah.
What are the ways you want to bring to these people?
Yeah, the questions are just kind of like, what do you do for work? What's your family situation? Because that weighs heavily, right? What are your goals? Like, keep asking questions about their goals, and risk tolerance, right? Like some people, they want to maximize money, and they might want to lend on a fix and flip. That's great, as long as they realize the risks in that. And of course, that a lot of it has to do with the operator, how many fix and flips they've done, through down markets and up markets. Those are kind of the questions I need to draw out of them, because they may not have an appetite for that. They might want something safe and secure, like a rent to own. We're getting into co-living, right? So we have options for them. Co-living, there's more hair on it, for lack of a better term. You're dealing with multiple people in a house. We handle the hosting, so it's passive for them. But yeah, just asking those kinds of questions, like just see what's a good fit for them. So did that answer your question?
Yes, you did. So you just want to understand how Pace Morby says, find Bunny, right? You want to understand their pain. You want to understand what kind of problem they have and what kind of solution you can to offer them. Is it correct?
Yeah. We're not forcing a square peg in a round hole, like whatever fits them. And if what we do, where our area of expertise isn't a fit, that's fine. We can make recommendations, and I know people in different areas of real estate that may be a better fit. And
Mm-hmm.
real estate may not be a fit for some people. I don't know why. You know, there's so many options, you know, and
Mm-hmm.
everybody's losing out. We in the business know the power of real estate. You know, I've seen it firsthand. So, yeah, just asking those questions and helping them make their own decision. You know,
Yep. Very cool. Very cool. James, how many years are you in real estate?
full time since 2019. Yeah, and I started
Mm.
learning way before that and getting into it. And you know, I've had 3 different mentors just in the rent to own space that kind of teach
Mm-hmm.
different things. There's a lot of crossover, but spent a lot of time and money on that, just making sure I'm fully an expert in those areas, you know. So if
Mm-hmm.
anybody's getting
Mm.
started, hire a mentor
I sup-
or
I
partner.
suppose you're expert. You're expert already because you wrote book even. Tell us please a
Yeah.
little bit about your book.
Um, yeah, I co-wrote a hybrid real estate investing book with Toby Henson, my business partner. So we've got that book. Um, there's a local Colorado real estate investing strategies book. In fact, I got the new issue that just came out this weekend. So
Mm.
this is on Amazon. So this is 2025. I've been in the last, well, since 2021, each
Mm-hmm.
edition. Um, it's got to be fresh content each year. Can't just write the same thing. But our strategies change as the market changes and as our experience changes. So every year I've had something fresh to add or tweak. So anyway, yeah, that's been cool to be a part of that because it's a crowdsourced book. So there's, you know, as you can see on the back there's multiple authors, including myself. So it's really cool. And though it's Colorado investors, it applies to people all over the country. Most markets, these strategies work maybe easier or harder than others.
Interesting.
So yeah, it's interesting to read what everybody else is doing too, and kind of validate why we're in the strategies we are. You know,
Yeah. Thank you so much, James. Yes. Thank you so much for sharing with us about your book. It's so cool. I've noticed not only you, but some friends of mine who real estate investors who are coming to the point where they have something really to share with people. Some of them they write the books.
yeah,
It's
it's a natural
it's
progression, right?
yeah, yeah, it's
Yeah.
very cool regularity. Yeah, I love it. I love it so much. And I actually one of my business partner, Chris James, he wrote the book, and I don't know the main topic about for this book. We are expecting this book to be out in February, and I'm so excited. I love it. I will
Oh,
write book as well one day.
what is the book about?
I believe it's real estate. Chris James. He is in sub 2 as well. And I believe it's real estate, but I don't know for sure. So it's so cool to see, and you have book, some more people have books. It's just awesome.
Yeah.
Okay, let's come back a little bit to our business. Okay, you got the private lender and you got the deal. Tell us, please, a little bit more the way or ways. How do you use private money in your business?
Okay. Yeah. So let's start with rent to own as an example.
Mhm.
So if we do a reverse lease option where we're buying something on market, um, if we're not personally with our company buying that house for that end buyer, then we partner with an investor that has the money for the down payment and the closing costs and the
Mhm.
ability to get a loan. unless they were loaded and could pay cash. But like in our market here, median price, depending where you are around Denver, is about $650,000. And you're losing out on the benefit of leverage. So if you're paying cash, right? So that's one way. That they've got the down payment, closing costs, and get a loan. We put the deal together. If we happen to get that property subject to, as we in the Pace Morby subject to world know, you don't have to go get a loan, but you have to come up with some amount of money to give to the seller that has the loan, maybe pay off arrears usually. So there's, an amount that's got to be paid up front. So they could come up with the cash for that. That same scenario applies for co-living. Still buying a single family home. Ideally, you're keeping that low interest rate loan in place. Somebody's got to come up with the money to pay off those arrears, help the seller with some moving money, or if there's some equity in there. And then with co-living, we're furnishing. So, and usually adding rooms, especially in the Denver market, we've got to add, ideally about 8 rooms in a house. So we've got to have a pretty good size house. Add, we've got a lot of homes where you got a formal dining room and a living room, and you only need one of those. So you might turn that dining room into a bedroom. In Colorado, we've got a lot of basements, unfinished basements. We can go in there, add a full bathroom, 2 or 3 bedrooms downstairs, and egress windows. Of course, we got to be compliant. So we've got teams that will go in and add that. And so got to come up with the money for that, and then furnish it. So in general, it's about $90,000. It's a pretty good chunk to get that set up. But the cash flow is amazing. And the reason we're in co-living is, a regular long-term rental won't cash flow here. Put 20-25% down and get a 7-8% interest rate. Our rents just won't support that. Over time it'd catch up. But co-living, you get a couple extra grand a month, even with the expenses, because there's expenses we charge with co-living by the room that say $850 per room average. That includes utilities, Wi-Fi, monthly cleans. We have a professional cleaner come in and clean. All that's included in the rent. So when we run our calculator, it includes all that, and the management side. So that's typically about 20%. So gotta, account for that.
Yeah.
But that higher amount of rent is where you can actually cash flow in a really tough market like this. So
Actually, I know that Colorado, it's the first state who officially supports co-living.
yes, it's a beautiful
Yep.
thing. No limit to how many unrelated people live in the home. Yeah, I think Washington and Oregon are the same. Maybe others will follow. But and the reason, it's a beautiful thing. So that just happened about 4 months ago. And also Pad Split, which for people that don't know is kind of like the Airbnb app for co-living. We're partners with them, and they came into Denver right about the same time the law got changed, which is perfect timing. And they asked us to partner with them on the hosting side. So what we do, should we dive into what that all looks like?
It will be too long conversation because about Pad Split it's too long. I guess you just explained about co-living, and Pad Split, this is just a brand, and co-living, this is a model, right? Where people rent rooms.
Exactly. Yeah.
Cool. So you mentioned you mostly involve equity partners, right? Investor who co-own property with you. You not just borrow money, or you do both.
Yeah, both. It just depends on the situation. Um,
Mhm.
like if we get a subject to deal, typically we just find a debt partner that would come up with the money for, you know, paying off the wholesaler and the arrears and putting the furnishings in. Um, we would go get a DSCR loan and or actually not with sub two, we just leave that deal in place. But so it'd be just a debt partner. We
Mhm.
also can do a 50-50 split. So if we're going and getting a loan, similar to the rent to own, that partner comes in with the cash up front, gets a loan, then we do all the work of acquisitions, setting up the house,
Mhm.
and hosting it. So we do a 50-50 split there. And so there is a 50-50 split of the cash flow and the equity
Mhm.
on the back end.
Mhm.
Yep. And
Mm.
like if an investor, this is another question we always ask an investor, like, do you want to turn your money a bunch, or is that a nightmare for you? Like, would you rather just make your cash flow? But things change too. So we might be 5 years down the road. Their plan was to hold it for 30 years, but all of a sudden something changed. The good thing is like a good cash flowing co-living house. I've got tons of investors like wanting that because it's less risky. It's just ready to go.
Mhm.
It's already cash flowing. It's already stabilized. So if an investor wanted to get out, there's plenty of other investors waiting to step in. So, yeah.
Great. James, what kind, how much cash flow a month you consider as a good cash flow for co-living property?
Yeah. Well, for every market's a little different, right? So 2000 cash flow would be,
After all expenses, right? After all
yeah,
expenses.
that'd be really good here. Yeah. Yeah. If we can make 1,000, that's great. I mean, you look at a long-term rental, they won't even cash flow, but you, the,
Yep.
the, the best deals are like $400 or $500. Um, so we're not like a cash flowing markets, like the Midwest, but they don't have appreciation. They might, things are
Mhm.
over recently have just been kind of going and going and going, but normally they're just flatline. You can't count on
Mhm.
appreciation, and you never want to count on it. But the Colorado market
Yep.
it fluctuates, but you can get some huge jumps, you know. So people want to live here. It's beautiful. We got mountains and climate's
Yeah.
good, and there's a lot of cool stuff to do. So we we, we get it. A lot of people do. It's just a more expensive market. And
Mhm.
going back to co-living, it's solving that affordability problem because in our market, a studio apartment's the median's about $1,450. A one
Mm.
bedroom apartment is about $1,650. And if they can get a bedroom for 850, 900, we're helping. Like one of the people we just got into one of our homes, she was living in her car when it was hitting like -7 at
Mm.
night low.
My
I'm like,
gosh.
so like she was homeless. And we've got a homeless problem here. That's helping. Like she couldn't afford 1,600 plus her car and insurance and all that, but she could afford this barely, so that's we're filling a need, and we're able to make money by setting up, and we've got the government trending in a good direction for us versus Airbnb, which is getting shut down and taxed, and it's a bit harder with Airbnb. So we're riding
Yep.
that wave. So it's a beautiful thing.
Absolutely. Absolutely. If someone cannot afford pay for studio 1,600, of course they cannot afford themselves to pay for Airbnb. It's absolutely clear.
Yep.
Yeah, I
Yeah.
would like to come back with you a little bit to how you structure your deals for equity partners for PMPs. So, we all familiar with the most traditional way to structure 50-50 equity and 50-50 cash flow. But some private lenders, so who I know personally, they agree to start sharing 50-50 right away, but some of them, they prefer to get all their investment capital back from the cash flow, which is sometimes 50 grand, sometimes 100, sometimes 120,000 grand, right? Depends. So it means investor like us, like you, like me, we are going to work for free for 8 years, 10 years sometimes. So you see absolutely different structures, absolutely different models. And what kind of models do you have experience with, or what is your opinion? Which models are more workable for everyone? And how do you prefer to structure your deals? To share cash flow right away, or you want them to get their investment capital back first?
Yeah, we prefer 50-50 cash flowing right off the bat and stay in the deal, for at least for us, cash flows is critical. We've got a lot of expenses. So it's not like we can wait, so that's kind of the best situation for us. So
Yeah, and usually it works for you, right? 50-50. Usually it works.
yeah.
Okay. And for how long you want your lender to stay with you? So I understand perfectly, unless this property gives a profit, right? Unless it works as a business. But I know just sometimes lender ask me, for how long you need me? For how long you need me as a lender to
Yeah.
co-own the property? So what usually you do in this case? How you answer them?
Well, because somebody else could step into a good cash flowing property, it's however long they want to be in. But ideally, they just stay in it. We don't have to go find another investor. 30 years. Like, we want to keep that property as long as we can, without having to swap somebody out. But it works however they want to do it. Same with rent to own. We've got to stay in it. Somebody could step into it that with a rent to own deal as well. But ideally, like most of them, like I was saying, most are 1 to 3 years. So I want an investor on board, ideally, that's going to stay in it that long. And sometimes we need to do an extension for a year or two. So maybe I like to prepare our investors like, hey, this could be, 1 to maybe 5 years. We're doing one right now. It's a regular deal where we had the property. We took a long-term rental, just a regular rental that was using property management. And we went and found a rent-to-own buyer. So that's kind of the more traditional way. And we gave them 10 years. So might make sense for them to get a loan in 5 years, kind of in the middle. But we've gone into it with the understanding we've given them 10 years, like probably stay in it that long. But if we need to get the investor out, we could do that.
Oh, yeah. Let's come to this point. If this situation, maybe lender wants their capital back, maybe whatever, it can happen, right? If they want to leave your partnership, how you structure this situation? Do they need to warn you sometime before? What is the time? Months, 2 months, 1 year? So how do you work with these situations?
We don't have that written down. It'd just be a conversation. We're low key. Just let us know, like the investors in it, right? If they need out, of course, we have to kind of start scrambling and put it out there and find a replacement, or that investor may know somebody that could step in and replace them too. So kind of put up the bat signal. Hey, we got somebody that needs to get out who's wants to step in. So yeah, we haven't had to have that happen. So not top of mind really, but it could. So
Mm, I'm asking because it's interesting to get to know other investors' experience, because the way how we structured our first deal we purchased, for example, we started to put in the agreement, lender has to warn us 3 months prior. So we need to we need really adequate time to find another lender, because it's not thousand, if it's not even 10,000. So we need time.
Yeah, yeah, that seems like a legitimate, like a good timeline. When you said that,
Hmm.
seems about right. Because yeah, nothing happens overnight. Like we've got a
Yeah.
pool of investors, but they're not always ready. They might be in the middle of something else where their money's tied
Hmm.
up, so or they might only want to do rent to own and not co-living or a syndication. So
Hmm.
you got to have a big pool, and our pool of investors is growing. So, um, but yeah, there's no guarantee. It's not like we got a fund that we can just dip into and cash out at an investor all of a sudden. You know,
Yep.
that that would be
Yep.
nice. I don't know if I'd want to deal with the headaches of that, but maybe we get to get to a point. That's a whole other story. Is creating a fund.
Yeah. And yeah, thank you so much, James. And I really like you are co-living advocate, and I know, I have small personal story and memory about Colorado. When I moved to US 10 years ago, for the first several years, I did not travel almost at all, because, this situation with documents, you need to get your green card and blah, blah, blah. I was studying in college, and my first job, lack of language. So almost first of my travel, it was in Denver. It was beginning of February,
Hmm.
and right after I landed into Denver and left the airport, I was shocked. I saw so many homeless people right on the streets. It was February. It was crazy cold. Because, yeah, I used to live that time in Minnesota. I did not see homeless at all, because small town in Minnesota, no homeless people, everything very quiet and simple.
Yeah.
Denver, megapolis, huge city, and homeless people. Oh my gosh. I
Yeah.
felt so sorry about these people. And I know right now situation with housing, not only in Colorado, everywhere, it goes worse and worse, and co-living is a great solution.
Yeah. Yeah. There's a reason the government's behind it. Thankfully, they see that we got to solve this problem, and this is a great way
Yep.
to do it. It's not going to solve all the problems, but most of them.
Hmm.
So there's a lot of people, because like this is for working professionals. They might work, you know,
Hmm.
a job at a restaurant, or there's plenty of jobs where people just barely getting by, and
Hmm.
so there's a lot of demand for it.
Hmm. Yeah. Oh, and I have another question to you. How do you present your deals to lenders? Accept personal relationship with you and numbers. What people usually pay attention on? What is important for lenders according to your experience?
Um, what's important? Safety and security that's the main things people are thinking about, right? Especially
Mhm.
for anybody. No one wants to lose money, right? They want their money to be safe and secure, um, and but they also want to make money, right? And so, uh, real estate, when done right, and when you're in the right asset class, you
Mhm.
can hedge a lot of those things. Like there's a reason we don't do fix and flips. Um, we like the safe, secure returns of rent to own and co-living. Um, so that's what we hear over and over. All our investors are just like, I don't want to lose money. I want it as safe and secure as possible. Um, does that answer your question?
let me ask you deeply.
Okay.
So, because safety can include many factors, right? Many different parts. So, for example, if I would be lender, I would really check location, right? I
Mhm.
would really check because uh, I really want to make sure the occupancy for this project will be high. So I need to understand who will be tenant in this property, why they want to live there, and what are their what makes them want to live in this house long.
Mhm.
For example, amount of parking. For example, public transportation right around the corner, bus stop, or as crime, low level of crime in this location, right? But what do you think usually lenders do? They check property that deep, or they interested only about numbers and personal relationship with you?
All of the above, definitely. Um, we have a buy box for co-living as an
Mhm,
example. Um,
mhm,
we don't want it in an HOA because they can trump that statewide law. Um,
yep.
like you were saying, you know, near near a bus line, in a safe neighborhood. So like we're for co-living, like B class, not the best of the best, A class. For one, those houses are more expensive. The people that live in those areas are more NIMBYs, not in my backyard. I don't want that co-living house. They're going to complain more. So class
Yep.
B, there's a little bit more leniency. High
Mhm,
class C, like we don't want to get into war zones. I've lived in war zones. I don't want to live there. I don't want to own a property, and my investors don't want to own a property in those war
mhm,
zones. Um, I think most investors kind of see things the same as I do, and that's why
mhm,
we relate. Um, so yeah, we'll look at those like crime maps and things like that. So um, the other thing, so we're doing the due diligence for these deals that we're doing with our investors, right? Like when we raise capital for multifamily,
mhm,
what it was kind of a cool situation where we had a group of fellow capital raisers, and multifamily deals, they're very unique. There's a lot of stuff you need to know, like how you run the
mhm,
numbers and how the property is operated, and if you're adding value to it, like how it's all run. Well,
mhm,
our situation was had a group of capital raisers and operators, people that were going out and finding the deals, fixing them up and running them over a long period of time. They'd come and they'd present a potential deal that they'd found, right? We would hammer them with questions. It was like Shark Tank. We're asking them like, hey, how many different properties have you owned? Have you gone through a downturn? Most multifamily operators are really in a bad spot right now because they had low interest rate debt, and their short-term loans, they
mhm,
went from 4% to 8, and all of a sudden they're in a
mhm,
hot water. So we're asking them those kinds of questions, and then if we liked their answers about how they operate and the specific deal they brought, then we jump in and keep going with our due diligence. And so we had a
mhm,
20-point due diligence checklist that we would go through. We get boots on the ground and go through the property. And so that was giving our passive investors comfort that we're doing that due diligence, because they don't know. You know, Dr. Dan doesn't know all those questions to ask about multifamily. Like, so that's the value we were bringing and the comfort level. Um, that we give to our investors for deals like that. In fact, we're
Mhm.
going to put together some presentations on different asset classes and the due diligence process and the questions you might want to ask. Because like we know IRA custodians, 1031 exchange companies, they've got people that need to put their money into things, but they don't know where to put it next. So if we can give them some ideas of what might be a best fit for them, then that's what I'm planning on doing. So anyway,
Interesting. James, how do you think, how important is to have capital raiser into your team?
capital raiser.
Yep.
Oh, it's vitally important. I mean, if you got a deal, you need money. If you get money, you need a deal. So it's like it's equally important. So
Yep. Very important. Because
always have to be.
yeah, we all do capital raising, but just some people, they do it professionally. There is only one thing they do.
Yep.
Yeah, just like my friend Amber McCollum, or some more people from sub 2, out of sub 2, they do just capital raising. Some of them even don't buy properties. They just do capital raising.
Yep.
And I believe that this is a blue dream for all investors who grow their business, to find these kind of capital raisers and to hire them and to build long-lasting relationship, because not many people can do it really professionally.
Yeah.
This is a great skill. Great
Yeah.
skill.
Yeah. We raised for 2 in the last year or so, and found like it was a lot of work. If you're only getting a few investors on board for a specific deal, the attorney fees eat you up. Like you gotta cover them and your CPAs and stuff. So unless you can raise $1 million, say, it's kind of not worth your time. So you have to have a big pool of investors that have the cash and are ready to go. Kind of keep doing that consistently. So
Yep.
you got it's a heavy lift to get off the ground. So a lot of people doing it and trying it, but I don't know how many are consistently successful doing that and able to like support themselves. But it's good target to shoot for. I think it's cool.
Yep. Very cool. And great skill. Great skill. Absolutely.
Yeah.
Yep. Thank you so much, James. I believe it was really, really interesting conversation. Honestly, and from bottom of my heart, thank you so much. Really, really interesting.
Oh,
And
awesome.
I really appreciate the way how you openly and honestly share your experience. Yeah, I got some great nuggets from you. And I believe people who watch us right now, who will be watching us in the future, guys, if you watch us right now, you have several minutes left. Please, if you have questions to James, feel free to ask in the chat. And you see, he is knowledgeable and experienced, and he will be happy to support you with any kind of information. And
Yep.
James, just to make this podcast a little bit funny, because it was so serious and so smart. Do you remember any funny situations related to your relationship with lenders, or maybe something funny while you were doing some deal?
Let's see. Well, I've got a few like horror stories, I guess. If we could get into that, like we had one of our rent-owned houses burn down, like total
Oh wow!
loss. So
Oh wow!
well, we turned that around because no one was hurt, thank God, and they didn't lose like all of their belongings. But there were, the investor, who's a good friend of mine, as an example, he's a pilot, makes good money, had invested in other real estate. He came to me, he's like, well, I got all this insurance money. Can you help me find another opportunity? So I kind of put out the word to my network, and I found a sober living house, which is similar to co-living, but it's just dedicated to people in alcohol recovery. It was already owned by another investor that needed to change gears. He was working on a big development, but anyway, got him into that. So, and that thing cash flows similar to a co-living house. It turned out okay, but when we got the call that the house caught fire, we're like, oh no. I got another one. Like I helped a friend get into a multifamily syndication in Florida. He wired his money, and like the next day, Hurricane Michael hit and wiped out Panama City.
Oh my gosh.
Yeah,
oh my
this
gosh.
complex, like the operator sent us pictures where parts of the roof and walls were missing. Like, oh my God. I'm like, oh, what have I done? Got my friend into this deal. But
it's crazy.
The good thing was it was a good operator. I knew they had a good track record. They got crews in there, fixed it up. There was insurance money that came through, got it up and running before most of the other buildings were up and running. I had to wait to get some cash flow, but it turned around. He doubled his money in 2 years. It's like, whew, thank God. So, yeah, sometimes it gets a little scary, but and it doesn't always work out perfect. But if you've got the principles and you've done your due diligence and you're working with good operators, that makes a huge difference. So, anyway, those are real deals.
Real deals, real stories. Yeah, sometimes life happens.
Yeah.
Not everything is so bright.
Yeah. Luckily, it doesn't happen on every deal. Just once in a while, something comes up. You got to just handle it. So,
Okay. I wish you, James, not to get into such situations anymore. Never, ever. Never, ever. It's such a stressful, right? It's not everything about mine. It's really such a stressful, like you said, you involved your friend into this deal, and it's not on you. It's not dependent on your will, but it happened, and it affects your relationship. Yeah.
Yep. Got to be very
Life
careful.
happens.
Yep.
Yeah. I wish you never, ever to get there. Never, ever. Yep. Only the best wishes.
Likewise.
Okay. Thank you so much. So we are about to finish our podcast. James, once again, it was really, really, really good. Thank you so much for your time. I appreciate you and your time a lot. And guys, I appreciate everyone who been today with us, who watch our podcast right now. Thank you so much for your time. I really, really believe you got lots of useful information from James, from his experience. Thank you so much for everyone. Thank you, James.
Right on.
Okay, let's go. Thank you so much and have a good night.